Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Oracle.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into the absolutely massive 60% drop we're seeing in the stock today, I do want to mention a quick resource. It can genuinely help when you're, navigating these kinds of extreme market swings.
Yeah, because it is rough out there right now.
Oh, it really is. So if you want some help reading trading charts more clearly, especially when a stock is testing multi-year lows like this one, you can check out VIP Algos. The link is below in the description.
Right, and VIP Algos, it's a TradingView indicator suite, right? Designed to basically make your chart analysis a lot cleaner.
Exactly. It gives you visual buy and sell chart alerts, trend direction tools, mapped out support and resistance zones, and even dedicated take profit and stop loss planning areas.
Wow, so pretty comprehensive.
Yeah, and versatile too. You can use it across stocks, forex, crypto, gold, indices, whatever you're looking at.
But, and I have to state this as a vital safety rule for everyone listening, VIP Algos is an educational chart analysis tool only. It is not financial advice.
Right, absolutely not.
It does not place any trades for you, and it absolutely does not guarantee profits. Trading always involves risk, so you have to manage your own risk and do your own research. Also, just full transparency, this is an affiliate link.
Yeah, which means we might earn a commission if you use it, but that comes at no extra cost to you.
Exactly. So let's jump right into the hook here, because right now, the broader tech sector is locked in what you could easily call like a brutal show-me phase.
Oh yeah, brutal is the right word.
For the last year, the market cheered every time a company even mentioned artificial intelligence. But that mood has violently shifted.
It has. The market is basically demanding hard proof now. They want to see that the billions of dollars pouring into AI infrastructure are actually going to generate real returns.
Right. And sitting directly in the crosshairs of this massive sentiment shift is Oracle. We're looking at a stock that is currently down a staggering 59.3% from its 52-week high.
Which is just a massive wipeout of wealth.
It really is. I mean, think about the sheer scale of that. It peaked up at $345.72 and has now plummeted all the way down to $140.64.
Trading near multi-year lows.
Yeah. So the central mystery we are unpacking for you today is this massive, relentless drawdown, a falling knife that you need to step far, far away from? Or are we looking at a rare, deep value opportunity to buy a mega cap tech giant on sale?
Well, it's the classic tension, right, between enduring short-term financial pain and executing a massive long-term technological transition.
Right.
You really have to look past the immediate panic to see the broader wealth-building context here.
But looking at that big picture, there's a very real, palpable sense of exhaustion in the market. I mean, aren't investors just completely burned out by the endless next-generation AI promises?
I get that. It definitely feels like every company just slapped an AI label on their earnings deck to juice the share price.
Exactly. And we're seeing this huge sector-wide pullback precisely because that initial hype cycle has popped. So why should a long-term investor put their hard-earned capital into a company whose stock has basically been cut in half?
Because this specific situation isn't about short-term hype, and it certainly isn't just an earnings deck buzzword. What we're witnessing is a multi-trillion-dollar fundamental transition in how global computing plumbing actually operates.
Computing plumbing, I like that.
Yeah, you have to understand that this company is no longer just that legacy database provider that enterprise IT departments complain about dealing with.
Right, they've evolved.
They are actively, aggressively transitioning into a critical foundational player in AI cloud infrastructure. So for an investor trying to build a resilient portfolio, this fits a very specific growth profile.
But it requires a strong stomach, I'd imagine.
Absolutely. It requires looking past the immediate short-term pain of these massive capital expenditure buildouts. I mean, they are spending billions on physical servers and real estate.
Yeah, and you have to focus entirely on the monetization phase that follows once that infrastructure is actually built.
Exactly.
But, and this is where I get skeptical, that physical build-out phase requires an absolute ocean of cash.
It does.
Which makes me question the underlying engine here. Like, are they actually generating enough money right now to pay for this new AI infrastructure? Or is this all built on borrowed time and hope?
Well, let's look at the fundamentals. The underlying business is actually operating with tremendous strength, which is the great irony when you look at that 60% share price drop.
Really? Tremendous strength.
Yeah. If you look under the hood at their financial engine, their trailing 12-month revenue growth is sitting at a very healthy 17.35%.
Wow, almost 18% for a company this size.
Right, and projecting out to fiscal year 2026, they've posted net income of $17 billion on a massive $67 billion in total revenue.
Okay, those are huge numbers.
But what really stands out, what tells the real story here, are the margins. They're pulling in a 65.82% gross margin and a 25.37% net margin. Earnings per share is sitting at $5.86.
Wait, so a 25% net margin?
Yeah, let's translate that. It means for every single dollar they bring in the door, they keep a quarter in pure bottom line profit.
Oh, wow. That is exactly the kind of cash-generating engine you need when you're trying to fund a massive pivot into AI.
Exactly.
Okay, so the cash engine is humming. The margins are undeniably solid. But the cloud infrastructure space is a brutal, unforgiving battlefield. You're up against Amazon, Microsoft, Google, the undisputed kings of the cloud.
Very true.
So what actually stops those trillion-dollar giants from just completely crushing them on price and scale?
It really comes down to their legacy dominance. The primary competitive moat here is built on extremely high switching costs.
Okay, heads up.
Think about it. If you're a massive global enterprise like a multinational bank or a global logistics firm, your entire operational nervous system runs on their database software. Right. Ripping out that database and migrating to a competitor like Amazon is a logistical nightmare. It risks catastrophic data loss, massive operational downtime, and astronomical transition costs.
So the customers are basically locked in.
Yeah, they know this, so they're leveraging that sort of hostage situation to cross-sell their own Oracle Cloud Infrastructure, or OCI.
Yeah.
But here's the really crucial part. They're actively fortifying that database moat with highly strategic hardware partnerships designed specifically for AI demand.
Right, the networking partnerships.
Yeah.
But let's unpack why that actually matters for a minute. Why does a networking partnership move the needle for an AI cloud?
Because AI training isn't just about having the fastest computer chips. It's about moving absolutely massive, unfathomable data sets between those chips without creating a traffic jam.
Oh, okay.
It's like having a Ferrari engine, but trying to fuel it through a coffee straw. It just doesn't work.
That makes perfect sense.
So they're actively collaborating with Arista Networks, heavily integrating Arista's 1.6 terabit per second Ethernet switching platform.
And this isn't just theoretical tech jargon, right?
Not at all. They are building out physical infrastructure that supports the massive AI training workloads for huge cloud providers. The hyperscalers like Meta and Microsoft.
Oh.
Yeah, if you have a data bottleneck during AI training, your multi-million-dollar computing clusters just sit there idle, wasting time and money.
So by proving that OCI can handle this data fire hose without choking, they're defending and actively expanding their market share against the pure-play cloud competitors.
Exactly.
Okay, I hear the margin strength and the lack of data bottlenecks makes perfect sense. But I have to push back here.
Go for it.
Because we cannot ignore the elephant in the room,
Right.
the massive debt load. We're currently seeing a $725 billion spending surge across these AI giants, and that has added roughly $350 billion collective debt to the tech industry.
It's a staggering amount of debt.
It is, and they are participating heavily in this surge. To use an analogy, it feels like taking out an absolutely massive high-interest corporate mortgage to build a state-of-the-art factory.
Right.
You're filling that factory with insanely expensive robotics.
Yeah.
All before you have a single guaranteed signed purchase order from a customer.
It's a fair point.
So is the market actually right to discount their valuations so severely right now? Because with a price-to-earnings ratio sitting at 24.07 and a price-to-sales of 6.10, the market clearly sees this capital expenditure, this CapEx margin compression, as an incredibly heavy anchor.
That factory mortgage analogy is perfect, so let's run with it. If you know for an absolute fact that every major corporation on Earth is going to require the product that factory produces over the next decade, you sign those mortgage papers without blinking.
Okay, so it's a calculated risk.
It's a calculated strategic investment to capture a once-in-a-generation technological transition. Yes, the market is severely punishing the stock right now because of the near-term CapEx burden. Building physical data centers is incredibly expensive.
And it drags down short-term earnings.
Right. But they are still successfully monetizing their cloud transition right now. They're even expanding their dividend history while doing it. So that PE of 24 suggests the market is already pricing in all of this short-term pain, which potentially creates a deep value entry point for you before that factory finishes construction and starts churning out those long-term guaranteed orders.
So if we are waiting for this theoretical factory to finish construction and start printing money, we need a timeline. And catalysts are what give us that timeline.
Exactly.
So what is actually going to move the needle in the next 3 months?
The most immediate fundamental catalyst will be their Q1 fiscal year 2027 earnings report, which typically hits the wire in September.
Okay, and what are we looking for there?
Investors and analysts are going to be laser focused on one specific metric: OCI revenue acceleration.
Meaning, are people actually using it?
Precisely. The market needs to see the actual utilization rates for these newly built AI data centers. Are customers actually renting the space?
Makes sense.
Alongside that, we're watching for ongoing deployment updates regarding those Arista-powered AI clusters we just discussed.
Right.
Every single time they announce a new computing cluster has successfully gone live, it proves the infrastructure is ready for the monetization phase.
Okay, but there is a much broader macroeconomic force at play here, too. The potential for Federal Reserve rate cuts.
Oh, absolutely. Huge catalyst.
But let me challenge this directly. Does a standard quarter-point rate cut from the Fed actually matter to a tech behemoth generating tens of billions in revenue? It feels like a rounding error for a company of this massive size.
It matters immensely. It's arguably the biggest macro catalyst for the entire tech sector right now.
Really? Just a quarter point?
Yeah. Let's go back to the factory mortgage analogy and that staggering $350 billion in collective industry debt.
Okay.
When a company is servicing debt on that massive scale, a lower cost of capital is exactly like instantly refinancing your corporate mortgage at a lower rate. A Fed rate cut instantly drops their interest expense.
Oh, I see.
And the beauty of that is those interest savings completely bypass operations and drop straight to the bottom line. It instantly improves their free cash flow profile without them having to sell a single additional cloud contract to a customer.
Wow, okay. That is a massive tailwind.
Right.
So we have a clear timeline for when the fundamental story might shift.
Right.
But catalysts only tell us what might happen. The technical price action tells us exactly what traders and institutions are willing to pay today. So what is the chart actually showing us?
The technical structure right now is genuinely fascinating. As we established, it's currently trading at $140.64.
Yeah.
That is sitting just barely above its 52-week low of $134.57. Year to date, the return is deeply negative, sitting at minus 26%.
Ouch.
Yeah, so the long-term trend is undeniably a severe, painful contraction from that $345 high.
But if you zoom in on the shorter time frames, there is a mechanism at work here. Over a recent 5-day window, we've seen a positive return of 2.8%.
Right.
And the crucial part is the volume. That upward movement happened on significantly elevated volume, trading at 1.34 times its average daily volume. Why does elevated volume at a multi-year low matter?
Because it's a massive psychological signal.
Okay.
When you see elevated volume stepping in right above a 52-week low, it indicates short-term stabilization. It means that dip buyers and large institutional value investors are looking at that $135 level and deciding it's cheap enough to step in.
So they're absorbing the massive selling pressure.
Exactly. They're defending that line in the sand, essentially creating a floor.
It's also worth noting how this stock moves relative to the rest of the market. The beta is currently sitting at 1.71.
High beta.
Very high. That means it is highly reactive. If the overall market rotates back into mega-cap tech, or if market sentiment shifts back favorably toward AI infrastructure, this stock is mathematically primed to see outsized upside volatility compared to the S&P 500.
It moves faster than the broader market, both ways.
Exactly. But as a vital point of caution for you listening, technicals always show probabilities, not absolute guarantees. A support level at $135 is just a line on a screen until the selling pressure overwhelms it and it breaks.
Very true.
And this is exactly why having a clean chart workflow is so critical, so you can clearly see if these zones are holding.
And, the sentiment driving that chart is incredibly fractured right now.
So if those institutional dip buyers are stepping in, what is the broader perception? Who is actually driving the narrative?
We're firmly in a heavily mixed show-me sentiment phase. If you scroll through the financial news flow, it's completely torn down the middle.
Really? How so?
On one hand, you have incredibly bullish analyst notes praising their aggressive adoption of Arista's AI networking. But on the other hand, you have Terrifying bearish macroeconomic headlines focused entirely on the sheer scale of tech infrastructure costs and the resulting debt burden.
But let's look at the people actually running the company, because the insider flow numbers caught my eye, and frankly, they look like a massive, glaring red flag.
Oh, the insider selling.
Yes. Over the past 90 days, we've seen net selling of over 121,000 shares. That breaks down to 19 insider buys up against 22 insider sells.
Right.
If the executives who see the internal data every day don't want to hold their own stock near its 52-week low, why on earth should the average investor?
It's a perfectly fair question, but you have to contextualize that volume. Yes, the insider flow is net negative, but 121,000 shares for a company of this colossal size is just a drop in the ocean.
You don't think it's a panic exit?
Not at all. This level of volume strongly suggests standard, scheduled profit-taking or routine tax-related selling rather than some panicked exit by the executive suite.
Okay, that makes sense.
Furthermore, there are zero short squeeze symptoms flagging on the tape right now.
Remind us what that means in this context.
Well, a short squeeze happens when a heavily shorted stock suddenly spikes, forcing short sellers to buy back in and driving the price artificially high. The complete lack of those symptoms tells us the stock is trading purely on its fundamental valuation right now.
So no speculative retail momentum or short seller manipulation.
Exactly.
There is some interesting speculative chatter happening in the background, though.
There is always the rumor mill in the financial sector.
Yeah. The current speculative chatter is that a major hyperscaler, one of those massive cloud providers like Meta or Microsoft, might shock the market by announcing an accelerated pivot to renting third-party cloud infrastructure.
Instead of building their own.
Right. To save on their own massive capital expenditures. If a massive hyperscaler decides to offshore a huge chunk of their AI compute to OCI, that would be a massive, completely unexpected catalyst.
It would be huge.
All right, that is the optimistic rumor. But let's explicitly balance this discussion. We need to talk about the risks because there are very real threats that could completely break this bullish thesis and send that chart right through the floor.
Absolutely. The most glaring risk is exactly what the market is currently terrified of. CapEx-driven margin compression. The heavy, relentless spending required to physically build these AI data centers could severely drag down their earnings in the short to medium term.
And if that monetization phase gets delayed?
If it's delayed for any reason, and those expensive Arista clusters just sit there idle, the immense cost of servicing that debt will eat directly into their profitability.
Wow.
Now, arguably, a massive amount of this fear is already priced in, given the 26% year-to-date drawdown, but it remains the absolute primary fundamental headwind.
There's also a very specific operational risk approaching fast on the regulatory front.
Yes, the UK situation.
In just 2 days, on July 13th, the UK is bringing major cloud providers, and this explicitly includes Oracle alongside Microsoft and Google under direct financial oversight.
Which is a huge shift.
It is. They are essentially going to be regulated more like critical financial infrastructure rather than software companies. Which makes sense when you think about the why.
Right, because cloud computing is now so deeply embedded in the global banking system. If these servers go down, the entire financial economy essentially halts.
Yes, exactly. But for the company itself, government regulatory compliance is never cheap.
It introduces massive operational friction. When a government regulator demands total transparency into how your cloud infrastructure is run, you have to hire armies of compliance officers.
And you face long delays in deploying new technology while you wait for approval.
Not to mention the constant threat of massive fines.
Yeah. If these new heavy regulatory costs compound at the exact same time that their profit margins are already being severely pressured by the massive infrastructure spending, that is a perfect storm. It could further delay any actual AI monetization.
Very true. So with all the data on the table, the robust cash engine against the massive debt, the $135 technical floor against a heavy insider selling, and the regulatory friction, what is the final verdict?
Well, looking at the complete picture, the data points to a 7 out of 10 bullish score.
Okay.
However, this requires a strict, unwavering, multi-year view.
Yeah.
This is absolutely not a quick momentum flip.
Right. No short-term guarantees here.
Exactly. This represents a rare, deep value opportunity in a mega-cap tech name. But it is exclusively for an investor who is willing and able to wait out the 12 to 24-month transition period.
Yeah.
You have to be willing to endure the painful AI build-out phase to eventually reach the highly profitable AI monetization phase.
The main upside driver here is the multiple re-rating. When the market decides to value the company higher, that will happen once that cloud infrastructure revenue begins to aggressively hit the bottom line.
And they're constantly protected by their unassailable database moat.
Right. But the main downside risk remains the sheer terrifying cost of the debt and the capital expenditure dragging down margins in the meantime.
Yeah,
This presents a fascinating scenario for a patient, growth-oriented value investor, but anyone looking for immediate short-term momentum should be very, very careful.
absolutely. Before we sign off, I want you to think back to that factory mortgage metaphor.
It's a good one.
Right now, the market is staring at the massive debt on the balance sheet and the half-built factory, and they are terrified. They've sold the stock down nearly 60%. But the underlying structural demand for the sheer AI computing power that factory will eventually produce isn't shrinking.
It's accelerating globally.
Exactly. So the provocative question you need to ask yourself is this. In the history of massive technological revolutions, has betting against the foundational infrastructure providers, right at the moment of maximum capital expenditure fear, ever been the wrong long-term move?
That's a great point to ponder.
It is something to seriously evaluate as you watch how traders react to that $135 support level. And as a final reminder, this analysis is not financial advice.
Nope.
You must always do your own research and understand that trading and investing involve significant risk. And if you want a cleaner, more efficient way to read trading charts and spot those critical support levels, check out VIP Algos through the link below in the description.
Highly recommend checking it out.
Yeah, VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make complex charts much easier to scan, but remember, it is still only an educational chart analysis tool.
Just education.
It is not financial advice, it absolutely does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and strictly manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.